This is John Occhi, Realtor with Keller Williams and the Excellence in Real Estate team. I'd like to join you. Thank you for joining me for the second part of my two-part video report on figuring out what the best financing is to buy your new house. Okay, so in the first part we talked about interviewing a mortgage broker, why a mortgage broker over a direct lender. Well, we talked about my good friend Rory Watson at the lending team, and you can reach him at 909-437-4647. I got to tell you, he's one of the true professionals in this industry, and someone, whether you use him or not, as I've said in the first part of the video, what you need to do is you need to interview 3 different mortgage brokers. There's no doubt about it. Just like any other professional that you're going to hire, make sure that you're getting the best, and it's somebody that you can work with, somebody that you can connect with. But I can almost guarantee you, Rory's your man. Okay, so hook up with Rory, give him a call, and then find 2 others. I don't care if they're from the radio, the yellow pages, from the junk mail that you get every day, the email you get on your computer off the internet, wherever you find them. Find 2 more, okay? Interview them, ask them the same questions, compare apples to apples and oranges to oranges, and make sure that you have somebody that you can work with. So what we talked about, what we wrapped up in the last segment, was talking about the pre-qualification letter. And this shows that you have been pre-qualified based on your income to debt ratio and your credit score and some of the preliminary information that you have provided. The pre-approval is a much more important process, and what this does is it literally gives you a blank check to go out and buy a home. And it's important, especially in a seller's market where it's very competitive. But today I've got to tell you, and this is spring of 2006, almost May of 2006, and there's many more homes available for sale than there are actually buyers. Okay, so as a buyer, a good pre-qualification letter is imperative. Pre-approval letter means that when you write your offer, it's pretty much a done deal, because the seller knows that they're dealing with a real buyer, someone who has the buying power behind them, and the only real criteria left at that point is that the home has to pass the home inspection and that it has to pass the appraisal process. And as long as the home appraises for the amount that's being offered, you're pretty much home free. Okay, so when you're working with a mortgage broker, there's a couple things that you need to be aware of. And there's really 2 important factors in determining your loan, okay? And the first one is interest rate. And you need to know whether you want to go with a fixed interest rate or if you want to go with a variable. And let me talk briefly about the 2 different types of programs. A fixed is pretty much traditional. That's pretty much what your parents and your grandparents had, you know, for the last 30, 40, 50, 60s, I don't know, back to the days of the Depression, I guess about 75 years now. Fixed rates have been pretty much the norm. And by a fixed rate, it means that you sign on the line, you get X number of dollars, your interest rate is Y, and your payment is Z. And nothing changes from payment 1 to payment 360, assuming a 30-year mortgage. Okay, actually that wouldn't be 300, yeah, 360, that's a 30-year mortgage. So nothing changes from one payment to the next. It's all about fixed. That's why they call it a fixed rate. Okay, it's a very safe, it's a very secure. The advantages is that it is very safe and very secure. No matter what happens in the economy, your payment is going to remain the same. It's something you can bank on. It's something that you know is not going to fluctuate. Now, a variable, and let me just share, you know, a variable has a lot of pros and cons. If you're only planning on being in a property for a short time, you know, say 2 years, maybe max 5 years, then a variable may be a good thing. Because let me back up, a fixed rate, they're usually going to charge a little bit higher interest rate, okay, than a variable. For example, right now you might be able to get into a fixed for 6%. Okay, let's just use round numbers and let's say 6%. So you have a $400,000 loan, let's say at 6%, and your payment is going to be, I don't know, a couple $1,000, $2,500, whatever it is, it's going to be the same payment month after month after month after month for 360 years. Now, a variable, that means that they take the interest rate and they base it on one of about 4 different indexes. Indexes are the cost of funds, and they use a LIBOR. There's a number of different terms, and you can always research them in the financial sections, like the Los Angeles Times or the New York Times. You can find them online. But these are like numbers that are like so obscure they really mean nothing to the average person. However, they are important because your variable is based on that. And some variables, they'll adjust interest every 6 months. Some they'll adjust once a year. Some they'll, after the first year, they'll adjust every month. okay? And it all depends on what happens with that particular rate that you're attached to, the index that you're attached to. And if that goes up, then your interest rate goes up. If it goes down, then your interest rate goes down, and on it goes. So your payments are really low. Now, typically what happens is when you get into a variable, you have a low interest rate to start with, okay, which is usually much more desirable. And what happens, and some people even get into interest only, and some get into below interest, so that there's a negative amortization. Interest only means that you're only paying the interest on the loan, regardless of what it is. If it goes up or down or wherever, it's it's attached to that index, and that's all you're paying. So the principal always remains the same. Scary, but if you're only going to be in the property for a couple of years and you're banking on the fact that property value, if you look at the history for the last 3 or 4, 5, 6 years, we've seen a steep increase in property value year after year after year. However, in today's market, spring of 2006, most people, and I say most, if not all, believe that we've plateaued in value. Now, the difference is some people think there's a bubble and the property values are going to go down dramatically, and we're going to see, terror in the streets and, some really drastic, dismal scenes. I personally don't think that's what's in store for us. I think is that, yes, we have hit the plateau. I think what we've done is we've done a major adjustment over the last 5 years. If we look back to what happened back in the late 80s, early 90s, by 91, the market had flattened out and it had gone backwards. And had it stayed on a constant, steady stream of 5 to 8% increase per year, the market would pretty much be where it is today. So we've seen an adjustment that has brought us back in line and adjusted for the bad years. We've made up for it in the last few years. And now what I'm expecting to see is a 5 to 8% increase in value in property over the next few years. Now, whether it's 1 year, 2, 5, or no, I don't think it'll be 10. I think a cycle lasts anywhere from 2 to 9 years. And I expect this to be a relatively short cycle, but I don't expect to see anything like we've seen where we've had 20 to 30% increase in the last few years. All right. So with that being said, we're talking about variable interest rates, okay? And if you're banking on the fact that property values are going to go up in the next 2 years, and you're only planning on staying in your house for 2 years, you're going to sell, take advantage of capital gains, cash out, move up to a bigger house, that whole strategy, then great. You get yourself into a interest only or a 1% loan or whatever the case may be. However, if you're looking at, wow, we found our dream house, this is where we're going to raise our family, we're going to live here for years, the kids have a great high school that they're going to go to in 10 years from now, and on it goes, then that's the case where you may want to look at a fixed rate, because you know that your payment will always be the same, and you don't have to worry about some funky loan that's going to come up and uproot you because you can't afford your payments that have doubled, okay? And they can double. All right, especially once it goes, because a lot of interest only, they're interest only for like 1 or 2 years, and then they go principal plus, there's a lot of variables. Make sure you understand your loan, because there's so many variables, okay? So interest rate is the one very important factor that you need to consider in choosing a loan. The other is how many points is the lender actually going to charge you. Most lenders charge 1% or 1 point for a loan. Now, if they're charging more than that, it's because you might have what they call subprime paper. Subprime is that you have less than desirable credit. Means that maybe you have no cash down on the to put down on the property. It may mean that you're going to pay an extra point in order to get a better interest rate. So these are all factors that you need to take into consideration, that you need to analyze for your particular situation. Remember in the very beginning I said there are no two loans, there are no two people, there are no two financial situations that are the same. That's why you need to analyze. Ask the questions, think, figure out what's best for you, okay? Because what's best for you is not what's best for me or for my other client or this client or that client or that client. It's what's best for you, all right? Very important that you understand that. So we've talked about the factors that are involved in a loan. Now I want to talk briefly about pre-qualification. We've already talked about pre-approval rather. We've already talked about pre-qualification, but now pre-approval is very important, because that's what gives you the blank check. That means that you've gone through underwriting with the lender, that you've jumped through all of their hoops, and there will be hoops. Let me tell you, there will be hoops. They're going to want to know all kinds of things about you. and they're going to want to see all kinds of documents, and they're going to keep on asking and asking and asking, because one thing is going to raise a question here, and they're going to want to see documents to back that up, and then that's going to raise a question someplace else. And you know, it's kind of like connecting the dots, and you can't. I wish you could just say, here's a list of paperwork, turn it all in and give it to the lender, and then wait a week and they say rubber stamp and say you're approved. But one thing leads to another, and that's what happens here. Okay, I want to wrap this up by letting you know that there are a lot of different programs available. I said earlier in the first segment that you want to ask the lender, the mortgage broker, what's the best program for you, but know that there are some 100% programs that are very good. There's even 100+%, so maybe 103 or even up to 107. I've even heard of some loans there have been in the past, and I just heard something here recently about 125. I got it in my own junk mail, 125% loan to value. Scary situation. Analyze it for yourself, and if it's right for you, it's right for you. I'm not going to tell you it's good. I'm not going to tell you it's bad. Everybody's situation is not the same. But there are some great programs. There's some government programs that you may qualify for. So get yourself educated in the process of home financing, just like you can educate yourself in the neighborhood that you're going to move into, make sure the schools and all that other stuff that has to do with the property. I can help you with that, and I talk about some of that in some of my other video reports that are available for you. But make sure you ask questions. That's all I can tell you. Ask questions, educate yourself, dig deep, and keep digging until you are 100% satisfied. Don't let anybody bamboozle you. Don't just like take what they're saying and go, put a dumb look on your mouth and nod your head because they're nodding their head and sign on the line like, I think this is what I'm supposed to be doing. Don't do that. Okay? All right. The more you know, the better equipped you are. So, and remember that the person that you're working with is a team member, someone that you're comfortable with working with. One more time, let me give a pitch for my good friend Rory Watson of the lending team. He's available at 909-437-4647. He's located in the heart of the Inland Empire, but he works throughout all of Southern California, and I think he's licensed in most states even. So please give him a call and let him find you the perfect loan for your perfect house. Okay, until next time, this is John Occhi with the Excellence in Real Estate team, and wishing you and yours all the best. Make sure that you make every day a special day, because they are all so precious. Okay, thank you. God bless to you and yours. Bye now.